Welcome to another episode of Beyond the Mortgage. I'm your host, Tracy Valko, and today I'm excited to sit down with Daniel Foch. He is the Chief Real Estate Officer for Valery, which is Canada's first AI-driven real estate brokerage. He leads the strategic initiatives that leverage technology and data to empower Canadians in their housing decisions. With his in-depth understanding of data, economics, and technology, and how that intersects with the housing market, Daniel brings a really informed perspective that helps shape where we are in the real estate market today in Canada. I'm excited to dive in and learn from Daniel's insights and experience. We've got lots of news to talk about today. Yesterday was a big day with the Bank of Canada's announcement. That's the second last announcement to the end of 2025, and we had some good news. We had a 0.25% drop. So tell me your thoughts on that and how you think Canada's economy is going to go in the direction, to the end of this year into 2026.
I think that a lot of economists seem to think that rate cuts might be over. And I think based on current data, that would, probably be correct. Employment was pretty strong last month. GDP isn't contracting or didn't in the most recent quarter. Could that change in the next readings that we'll see before the Bank of Canada's next announcements? Yeah. And I would say that's probably a likely outcome. So I'm not fully convinced they won't cut further, but the Bank of Canada sort of alluded to themselves that as it stands, based on the data that they're using, it doesn't seem like there are more cuts on the table. And most economists are saying we might have to wait until 2026. So I think that honestly, everyone's sort of in a holding pattern and just waiting to see what the next, I think your next unemployment, your next inflation, and your next GDP readings say. I think that once you have that data, we have a clearer picture of the direction that things are going to go.
So we can know that Canadians really look at these numbers now. We traditionally haven't seen that, but I think everyone's so sensitive to inflation, how the market's reacting to, like, say, their bottom line, their pocketbooks. We have a lot more activity, I find, in the housing market when the Bank of Canada makes their announcement, but this time seems a little bit different over the last day. Even though we've had that 0.25% drop, I think when we're looking at Canadians and housing, a lot of people, it's the affordability is becoming really challenging. And even with those 0.25% drops, is it enough to move the needle? Having said that, like, this is the fourth one that we've had this year, which is significant. We came off the peak of, from 3 years ago, we've actually had 10 decreases, and we were at the peak of 7.2, and now we're down to 4.45. It just doesn't seem to be enough. Like, what do you think some of the other factors that are challenging right now for Canadians and home ownership?
I think, the biggest issue with the bank paying attention to the Bank of Canada is that they really are only gaming one side of the curve, right?
Hmm.
When they were decreasing rates, they weren't really adding buying power to the market because people had already pulled back from the variable rate, right? Like everybody piled into the variable rate during 21, early 22, because the bond market pushed your 5-year yields up in anticipation that the Bank of Canada was going to have to hike. And so your fixed rates were actually being stress tested at a higher rate than your variables. And so everybody was going into the variables during that period of time to get as much buying power as they could because they needed it when prices were running up like crazy in 2021. But ever since then, people have very much switched to the fixed, and they were taking maybe shorter fixed, 2-3 years. But by and large, people choose a fixed mortgage product. And so the bond market is more in control of what buyers are doing. So the Bank of Canada is really only in control of how sellers, the sellers or owners, let's call it, the owners who are already in a variable rate. The Bank of Canada is really only impacting them, right? They're easing pressure on them. They're not adding buying power into the market. We just started seeing an increase in the number of people taking variable rates as a percentage of total based on CMHC's most recent reading. And so now maybe we're getting a little bit of buying power being added from from Bank of Canada cutting. Even then, there's also a limit to how much buying power they can add because now we're at that 5% or 5.25% minimum qualifying rate. And so even if they cut, people are still qualifying at 5.25%. So unless the stress test goes away, it was I think 3 or 4 cuts ago, once we cross that threshold, any more interest rates or interest rate cuts that they do isn't actually going to materialize in more buying power for borrowers because of the stress test. So combining that with the fact that the majority of borrowers are still using fixed rate mortgages, I'd say the bond market's in control. And the only thing that's really going to actually alleviate pressure and create more affordability, maybe not more affordability, but more qualifiability or attainability, is removal of OSFI's stress test, which sounds like we could see that next year.
Yeah, and I mean, there's lots of conversation on that, on how they're going to look at maybe some different metrics to be able to qualify clients. And that could still be challenging for people. I think ultimately, when we're seeing what's happening right now, I mean, we're still seeing that conversation. Our team, when we talk to clients on the financing side, a lot of people are still under this misunderstanding that with bank prime coming down, it's going to help them qualify for more because I think it has something to correlate with fixed rates. And yesterday's announcement, we actually saw the bond yields go up. Now, we haven't seen banks today or lenders increase interest rates. In fact, at the beginning of this week, we started to see some rates coming down under 4%, which is nice. But what's your reaction to or your thoughts on the bond yields going up?
Well, I think the bond yield curve really just tells me that the bond market expects that the Canadian government is going to have to spend a lot of money, regardless of whether or not that becomes inflationary. Like if the Canadian government has to run a record deficit by the end of this year, early next year, we'll know almost instantly if that's the case based on how the bond yield curve reacts to the budget 2025 announcement. Like just basically watch the Canada 5-year on the budget day. But if we're going to run $100 million deficit, like that's a lot of bonds that the Canadian government needs to issue. And if we have to do that, then bond traders and purchasers have a little bit more negotiating power with the government, who's the one paying the interest rate. And so I'm of the opinion that I think the bond market is basically just telegraphing that they believe that Carney is going to run a record deficit and that they are prepared to buy the bonds, but their expectation on the yield is a higher rate. And so that's sort of, I think, where we're at. I don't think it has much more to do than anything other than that. And that's sort of why a lot of economists are seeing the long-term and sort of 5-year forecast for the Canada 5-year bond yield, and then your 5-year fixed mortgage rates tends to be moving up towards the end of next year.
It's interesting because I think the economists right now are kind of on different spectrums. I was listening to Benjamin Tal last week, and he talked about how rates will eventually have to be forced to come down because it's going to help move the market better, and because of where we're going to be with unemployment. And a lot of companies leaving Canada, going back to the US or maybe other countries because of what's going on with tariffs, and we're not able to come in aligned in terms of being able to make an agreement with the US. Well, right now it doesn't look very optimistic. What's your thought on that? Like, because there is a bit of a divide right now, I find, with some of the economists.
Yeah, I would say I agree with Tal's thoughts on that, except that the Bank of Canada doesn't really care about unemployment. Like they're not like the US. Like obviously they'll read unemployment as a potential future signal towards inflation, but they're really they're single mandate central bank, and their mandate is to protect against the inflation rate. And so you kind of have two converging forces. There's this idea called fiscal dominance, which basically means that so you have two sort of branches of how the government can stimulate the economy. One is monetary policy, which is the Bank of Canada, and that controls the interest rate and how much money is coming in or out of the economy through money supply, through things like quantitative easing. And then you also have the fiscal side, which is the government of Canada, federal government, spending money and issuing bonds to do that. And if the federal government spends such a substantial amount of money, I think that you saw this during, like a very good example of this would be like 2021 when you saw stimulus money, right, from both the Canadian government and the US government. And I remember Powell was sort of saying like, I'm not the one spending all of this money, right? Like that. And sort of the same thing from Tiff's perspective, where he basically said like, it's going to be really hard for us to continue to fight inflation. The government keeps writing checks for $2,500 a month for people who, are impacted by COVID or whatever. And so that would be fiscal dominance. They can't actually change the outcome of inflation if the government is printing or spending so much money, and that money is being used in the economy to, I guess during COVID, it was like buy boats and buy jet skis and buy houses and whatever. But right now it's keeping people employed. Like if the government's spending, if we're running $100 million deficit and a lot of that's going to capital projects and we're building houses and we're building subways and et cetera, unemployment might not actually be a huge concern. This is what happens during, you go back to the 90s, the 80s, you saw a lot of these make work projects where the government would spend a ton of money. The challenge is that that's inflationary. And if it ends up becoming inflationary, then the central bank, that's fiscal dominance, right? The government is the one sort of stimulating the economy to the point where the central bank might not be able to cut further because the economy on paper is too strong for them to necessitate cuts. And I mean, from my perspective, if you're running a $100 billion deficit in Canada, I think it's a real potential outcome. And I think that's the outcome that the bond market seems to be modeling for. And it sounds like that's potentially the outcome that Tiff is also considering when he's talking about potentially having to stop cuts, because we're going to have a budget by the time they cut next. I think it's in 2 weeks. So once we have a budget, we know, and once we know how much money the government plans to spend, you can kind of model the growth of the economy accordingly off of that.
And do you think that budget's going to be very inflationary then for the economy, right? Because they're obviously going to be spending a lot of money to help stimulate the market.
Yeah, I mean, that would be my assumption. I think that's kind of their objective, right? Mm-hmm. Inflation for them is growth of the economy.
I think that when you look at it right now, it's interesting. I was on a call this morning and was speaking to one of my other mortgage professional colleagues, and he was talking about the market out west, and we're looking at like Saskatchewan and Manitoba and some of these other provinces where people in my industry are having record years of volume, record years of activity. And again, I'm predominantly, obviously, we both live in Ontario, but I know we work nationally. But it's very interesting how the perspective is so different, because I think it's hit us in Ontario and BC a lot harder because we've had this influx of values specifically over the last 5 years, but like we've seen this big fallout of values over the last three. Where do you see those other markets? Do you think those other markets will see the same cycle we had, or do you think that we'll have a recovery potentially maybe in 2027?
Well, I think most of them have sort of already started their recovery, or just not really collapsed the way that we saw Ontario and BC. And I think the big reason for that is because people can afford to buy houses there. In Ontario, people in BC during COVID, like prices ran up so severely for a variety of factors, but a lot of it was monetary policy. A lot of it was millennials coming of age and buying houses. And a lot of it was people leaving the cities and buying in the suburbs. Those were the key converging factors. You didn't see that happen in Saskatchewan or Manitoba or whatever. You saw maybe a little bit of it in Alberta, Calgary, which seems to be rolling over a bit. You saw it go into Halifax. A lot of Ontarians moving to like Halifax. That caused a pretty big run up in prices there. And then prices dropped pretty substantially after that. I think a lot of the markets where they're still running, they're 2-3 years behind Ontario. Will they see a correction? Probably not. And I think the reason is just kind of what I started with. A regular person can buy a house in Saskatchewan. A regular person can buy a house in Winnipeg, and in many places in Canada, and the majority of cities, I guess you could say, in Canada. But out, in Ontario and BC, regular people can't, and so that's why prices are going to have to come down until the average buyer can afford to buy a house. You can't have a market recovery until buyers can afford to buy. Buyers won't buy until they can afford to buy. Maybe the stress test changes that a little bit, but it's not going to change it a ton.
And how far do you think that correction will be? Because what you're talking about, I think right now, like our income hasn't indexed to inflation, let alone the cost of housing. Do you think, especially in Ontario, let's just talk even about Ontario right now, do you think that will happen in the near future?
Well, I don't think incomes are going to go up. Like, I don't think in a meaningful way. I think incomes are up 3% wage growth. I think interest rates will come down a little bit more, based on the data that I think we'll probably see. So maybe early next year. I think wages will grow a little bit, probably 3%. And I think prices will come down. I mean, you don't need much more on prices. You need like 5-10%. Right. You can maybe you assume that like a Toronto and Vancouver will probably always be unaffordable, right? Similar to like New York and LA. Like they're just your kind of major global trade hubs where everybody wants to move. Those are places where affordability might just never exist.
So if you're looking at, I know you're a data person and I see everything that you put out there. And I mean, you've got a lot of people following what you do and what you say. As a homeowner or a potential homeowner, people can get inundated with all the information online, right? What would you tell someone that was looking to buy or even looking to invest right now? What are the metrics, or what should they be looking at to be able to follow along with what's going on, to be able to take an opportunity sometimes in these challenge markets?
Yeah, I would say, the first thing I would do is like actually run the numbers on your purchase, whether it's an investment or as an individual. I think most people don't do that. They say they do, but they don't, right? Like nobody's really run the numbers of like, what would it look like if I actually just rented the same house for 5 years and invested the cost differential in S&P 500? Or what would it look like if I didn't, or if I took the money to buy this investment property and put it into a different type of investment. So actually run those numbers, run a cost benefit analysis on all of the investments that you're going to make. That's probably the first thing I would say is like, that's the scope of things that you as an individual can actually change. If you're just trying to like get an understanding for like, where's the market at and when's it going to turn? I think the big thing to me is, I think there's two key factors. The first one is unemployment, or the employment level. So, I don't see us growing. I don't see our housing market growing at a national level, and especially not in Ontario and BC, if we're still losing jobs. So if unemployment is rising, it would be surprising to see a turnaround in the housing market. If people are losing jobs, then that means they're unable to pay their mortgages, which means they have to sell their houses. And it means that buyers maybe are more fearful, or there's fewer buyers because the buyers are afraid that they might be the one to lose their job. So that's the first data point. And the second data point is whether or not Canadians are actually deleveraging. And the big reason for that is, we honestly, like, and you understand this as a mortgage broker, as an individual, you can only take on so much debt. So if you have a maxed out credit card and a couple car loans and whatever, you can't go and get a mortgage, maybe, I don't know. But that's the position that we're in as a society right now, is we all carry too much debt. We have the highest household indebtedness relative to income in the world. And the only way we can grow is, there's two ways. I guess you totally burn it to the ground and have your economy not built on debt anymore, and then start from scratch, which I don't see happening. The other one is we need to build some room in here, because in order for us to grow our economy, we need to be able to borrow more money, and we can't borrow more money if our household debt to income, like in a large generalistic fashion, we can't increase our household indebtedness higher than where we're at. So what we need to do is Canadians need to start deleveraging, and deleveraging looks like selling your house, selling your jet skis, whatever, giving up the car payment, one of the cars, or whatever it is, right? Getting rid of products that have debt attached to them. We were seeing it happen, but it started to revert in the last month. So I think if that trend continues, we start to see Canadians deleverage. And, I think until you get to like kind of 90% of household income, I can't see us growing our economy on an expenditure perspective, because we just don't have the capacity to take on more debt.
I think that it's interesting because I've been doing this for 3 decades now. And when I look at mortgage financing, I remember the days where we were doing financing for investment properties with 5% down. And,
Yeah.
People were not defaulting. Like if you look at the default rates right now on mortgages, it's the highest ever. The power of sales are the highest ever. But it all comes down to, I think, the cost of living in Canada. If we could help bring some of those metrics down, housing definitely has gone up. But when you look at going to the grocery store, anywhere you go now, everything is hitting your pocketbook. So that eventually is going to hit ahead with people. They're just going to have to borrow to survive, because income's not, again, going back to indexing to inflation. So if we could look at alleviating some of those key metrics, I think in the cost of living in Canada, it can help people get back to the opportunity of at least just buying an owner-occupied property, not even investment at this point. And that's where I think that policies need to change with the government. I think, to your point, like the stress test, is that going to be alleviated, or are we going to look at another metric that's more measurable? Or going back to like when we were doing those, 95% investment property purchases, we were also doing 35-year amortizations. Actually, in fact, there's programs out there we were doing 40 and no one defaulted. And we could say it's a different time, but when you look at it, history does tell a story. And I think history can repeat in a positive way. It's the rationale behind the government. But there's more challenges now, like tariffs. We've had tariffs before, but I think there's a lot more challenges. It's hard for people to make a decision right now, what to do, what to buy. And then you've got massive unemployment that continuously is on social media. Like if you were recommending to a client right now, what to do in terms of should they be buying in this market, what would be some of your recommendations, or what are you finding with your realtor team, what they're suggesting?
I think the big thing is just like be patient. Look, like people have been rewarded for being patient for the first time in like 30 years in Canadian real estate. Before that, it was always like you had to rush. You had to buy as soon as you could because FOMO and prices were going up. And, if you didn't buy, then it was going to cost you more. But that hasn't been the case for the last 3 years since 2022. as it stands, it probably won't be the case for the next 2 years, I would say, maybe a year, right?
Yeah.
And so until prices turn around, people don't really have a sense of urgency, and nor should they. Like, they should be careful, they should be considerate, they should examine their employment situation and make sure that they're insulated from any further downturns and rounds of layoffs and all of those things. So that's really the way that we're advising people right now. And I think a lot of our agents are basically saying, look, you don't have to buy a house right now. But you could find a really good deal, and I would encourage you to buy it if we could do that. And so that's really the work of the real estate profession at the moment. Is we have record inventory, and that should make it possible for people to find good deals. What does it take for us to find good deals? Well, we have to go and look at a lot of properties. We have to have our realtor go through thousands of listings, and then we have to be willing to submit offers, lowball offers on dozens of different listings to try and negotiate the best price. And maybe we have to wait and risk losing one, or, walking away from the negotiating table because we, feel like we didn't get the best deal. We're in a market right now where there's a lot of distressed sellers. There's a lot of sellers who are just, oh, I'd love to sell. This is a headache. I don't like landlord and tenant board. It's costing me too much, or mortgage renewal coming up, or whatever. There's a lot of people on fishing trips, but then there's a lot of real sellers, people who really, really need to sell. There's a lot of power of sale properties. All of those are going to clear. Banks don't want them. Banks do not want to take those properties over. All of the power of sale listings in the current market are going to clear, a massive percentage of them. So to me, the way that we're advising people is demand a lot of your real estate professional. Ask your agent for a lot. Ask them to go and look through thousands of properties. Ask them to see lots of listings in person. Ask them to throw a lowball offer in and try and negotiate and earn their paycheck. Honestly, the recommendation that I'm seeing in the market right now. And I don't see, the other thing is, if you assume that every property is on the MLS is listed at market value, which isn't the case, but let's just make that assumption. Mm-hmm. And you also think prices are going to fall 10 or 20%, you can capture the future value. Like, the thing about real estate is you do get a benefit from owning it earlier, because every mortgage payment that goes by, you pay more principal, less interest. And, and also it pays you rent, let's call it, right? So either you're not renting, or it's, you're collecting rent from somebody in that unit. So there is a benefit to owning real estate earlier. So if you can get tomorrow's price, if you're worried prices are going to fall 10% and you want to buy in October of 2026 instead of present day, then why not offer the price that you think that it's going to be worth in October of 2026? And if the seller takes it, great. You just got possession of an asset at tomorrow's price, in present day, especially given, what we discussed at the beginning of this conversation in regards to interest rates. If you think interest rates are going to go up and prices are going to come down, well, you might actually be better to buy earlier and buy in the best rate environment. And if you can negotiate the best price environment as well.
So it's knowing your numbers, right? That's where everybody needs to be right now, I think, in case really, really diving in, which they should have done already, but this even more so, right?
Well, I think people got away from it during the pandemic because there was no, there was a moral hazard, right? Like, there was no reason to do things correctly. Like, it was just, everything was a rush, and nobody was getting home inspections, nobody was getting financing conditions, et cetera, right? Like, they were just like, I'm just going to buy this place because, as far as I can tell, it's gone up for the past 3 years, 10% year over year. It should do that next year. And so it would just be stupid for me not to buy this thing. For those of us who saw, and have seen past cycles and saw how that would end, it wasn't hard to see that was not a good idea, but most people aren't in that position.
And I've always said too, is I think with every market or every cycle, it's different, but we 100% recover, right? It just looks different, right? So just to kind of end on this great conversation, which I know we'll always pick up because the market's always changing. What do you foresee for the last announcement, December 10th, as of today? I know that can change in a day or a week or an hour, but what's your thought for the next Bank of Canada announcement?
I think that they will hold as it stands. I think and I think right now, budget 2025, basically forecasting a $100 billion deficit is probably the reason why, other than obviously the economic data isn't that bad either. But if GDP is, because I think we should get Q3 GDP. If Q3 GDP is in contraction again, because remember we saw a contraction in Q1, then we're fine in Q2. Am I getting that right? There was a down quarter and an up quarter. If we get another down quarter, I think I think that is where the Bank of Canada probably would I think that more than unemployment, because again, like they don't really care about unemployment.
Mm-hmm.
They're not like the Fed where they have a full employment mandate. And then I think CPI, if GDP is contracting, CPI or the inflation rate should be coming down as well. The only challenge with this is, and this is where that whole trade war and tariff stuff really comes into play, is like the reason we saw that the increase in GDP growth in Q2 or 3 was because manufacturers or companies that were like have to buy goods from the US or would have been subject to tariffs, they went and bought all of those goods. Like let me give like the easiest example is like when Apple was buying like flying airplanes full of phones from India over, because they were worried that if they had to move them to US soil, because if they stayed in India, then a couple of months later they would have been subject to tariffs, or a couple of days later. So that pulls forward a bunch of demand, right? So now all of a sudden, if I'm like a company that's buying, again, like iPhones, I'm going to go buy like full year's worth of iPhones. So it looks like I just did a ton of economic activity, right? That's like shows up as a huge bump in the, but then later on for the next year, I'm not buying any more iPhones. And so it reduces my GDP growth after that. So this is why the trade war and the fear of tariffs and the constant up and down of whether tariffs are on or off, right? The whole like light switch thing is going to have a really turbulent ride for Canada's economy on the GDP growth side of things. I am very, very grateful that I'm not in Tiff Macklem's position right now, because he has a really, really, he's been dealt a very difficult hand, especially like even, first COVID and then this stuff. So yeah. So, I mean, I do think that they're doing a pretty good job, but yeah, I'm of the expectation that we won't see a cut in December unless we see inflation the next inflation reading is low and like significantly low, or GDP growth is falling.
Thank you so much, Daniel, for your time. I know you're very busy as well, but your information and your knowledge is so paramount for everyone that's listening to continue to make, the decisions they need to do to drive financial and, holistic wellness for themselves. So again, thank you for your time.
Yeah, my pleasure.
And to everyone tuning in, thank you so much for joining in today's conversation. If you enjoyed today's episode, please subscribe and share it to your friends, family, and network. Help us spread the word. And until next time, keep supporting one another and stay connected to your amazing community.